I do think all capital markets move on chain over time in the same way that almost all commerce eventually became e-commerce.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Sid, thank you so much for joining me today. Super excited to chat with you. All right, Sid, you are the founder and CEO of Maple Finance and Syrup Finance. Maple Finance is a permissioned DeFi platform that offers lending and yield opportunities to qualified clients. Syrup Finance is a permissionless protocol that provides institutional yield to the wider DeFi ecosystem. And also, you previously worked in TradFi at a company called Angle Finance and also the National Bank of Australia. All right, so Sid, take me all the way back. Let's go to, I guess, college time. Were you studying finance? Were you interested in finance from an early age, or was that kind of something that formulated over some period of time?
Yeah. Well, first of all, thanks for having me on. So going back, yeah, I was definitely always interested in finance from like a young age. So I would read, investing books. When I was in university or college, I was reading biographies of Warren Buffett and that type of thing. I actually always thought I wanted to be an investor. But I did go and study finance. But actually also studied law. So I kind of hedged my bets. I wasn't sure whether I would be a lawyer or whether I would be, an investor or something in finance. My dad was a stockbroker. And so I think that kind of influenced the direction I wanted to head in. But then after university and college, I managed to get a grad gig in banking in Australia. So I went and worked at National Australia Bank. I moved to Melbourne from Adelaide, which is where I grew up. And where I got in it was funny. I just got my foot in the door. So I got into operations and I was in that work stream, but then I sort of desperately tried to work my way across to like investing, asset management, that part of the bank. And I managed to click. I sort of clicked and I developed this relationship with a guy who was in securitization. So we were both interested in Warren Buffett and investing. And then he gave me an opportunity to second into this area called securitization, which was doing debt capital markets. And so I then went to work in that team. And so that was helping lending companies to borrow by issuing bonds into the market. So it was like the closest part to investment banking that you could do within the bank, in that it was touching markets, it was touching, producing decks and things for investors. It was very sort of rigorous and challenging. And then I worked there for was about 3 years. And then I had this point where I kind of looked ahead and I was thinking, the bank is 20,000 plus people. To keep working my way up here is gonna take years, and it's very political. It's very hierarchical. And so I was thinking, do I want to go back to university and learn how to code and do something in tech? Do I want to stay in finance but go to a tech company, or do I want to leave financing and go and do something else entirely? But I had this recruiter contact me, and he gave me this opportunity to go work at what then became Angle Finance. And so I went there and ran their treasury. But the idea was they were small, they were publicly listed, they were growing really, really fast, and I had that opportunity to kind of, push myself into a different challenge.
Okay, so your background was in law and finance. I bet you when you first discovered smart contracts, you're probably like, oh my gosh, like this is awesome. It's like perfect,
When I first heard of Bitcoin, because I was in the bank and I was reading Warren Buffett letters, I initially thought Bitcoin was a total scam. And I had this other graduate who was like, you should buy Bitcoin. This was from back in 2014. And I wish I'd listened to him instead. I told him he was stupid.
That's so funny. Okay, so at what stage did you discover crypto? And I guess 2014, but at what stage did you start to, change your thought process around it? Because, I think a lot of people that were in a professional setting, especially in TradFi, obviously had your same viewpoint where it's like, oh, this makes no sense, obviously. So when did you first discover, When did you first start to think, okay, there's actually something here?
Once I went to work in that other job, so Angle Finance, it was like late 2017, I started getting interested in Bitcoin and Ethereum. That was when I first heard about it. I'd maybe heard about Ethereum a little bit before, but I hadn't really paid any attention to it. And once I was there, I started paying attention, buying a little bit. But uh, the part of crypto that kind of, and smart contracts that really caught my attention early on was this idea that, we were doing tranched bonds, right? When I was in banking. And so the idea that actually every single dollar of the bond transaction could be its own bond class because you could program it all with smart contracts. That was kind of the initial thing that really excited me. And then when I was a client of the bank and no longer inside the bank, I could see how bad the service really is when you're a bank client. The bank goes at its pace, and meanwhile you have a business that's trying to grow, or it's facing debts or other obligations, and so I was like, we would be in a much better position if we could just access debt capital markets the same way that the bank does for other clients. And so it was mid 2018, we started hashing out this idea for Maple, which was, could we do tokenized bonds on chain the way I'd been doing tokenized bonds when I was at the bank, and then trying to raise that when I was at, what is now Angle Finance. And so 6 months of talking about it, then in January, I went on this kind of bender of just trying to write a white paper. And then it was mid 2019 that we incorporated the company and then started trying to do a proof of concept. And so we're in Australia. I started going to all the Ethereum meetups and the Web3 meetups at the local university. And then I found this software team that would build a proof of concept for us. And so me and my co-founder, who I met working at that company after NAB, we started just plowing our savings into trying to develop a proof of concept for what is now Maple. But it was that kind of original idea at the beginning.
That's amazing. Wow. Okay. So, all right. So the thought process was, oh my gosh, with smart contracts and kind of permissionless DeFi, which wasn't actually a term back then.
Yeah, there was five. All of DeFi was like 5 companies. So it was Maker, Set Protocol, DYDX, Dharma, which doesn't exist anymore, which was doing peer-to-peer loans, and I think Compound was just starting around then too, and I think Uniswap was soon to be invented.
That's crazy. Okay, so and for you, the thought process was we could radically transform debt capital markets with this technology, and we want to be the ones to build it.
Yeah, the idea was in those days, if you're a lending company, if you didn't have at least 100 million in loans outstanding already, a bank wouldn't look at you to take you to a debt capital market issuance. And so the idea was like, how do we shrink the cost 10x or 100x so that smaller companies like what we had been at could raise debt from capital markets. So there's this whole idea of, and I know Jeremy Allaire from Circle still talks about this, but this idea of the long tail of capital markets. There's all these companies who, if only the cost were lower than what it is now in traditional finance, would be coming to the market.
And you weren't technical, and neither was your co-founder. So you guys were like, all right, we need to put all of our money into these folks that we know, this dev shop, and create the MVP from that, right?
Yeah, exactly. So neither of us were technical. And so I remember we applied to this accelerator, and initially they didn't want to take us because neither of us were technical, and they thought you had to have a technical co-founder. But what we did was, as soon as we raised, we then hired the right engineering talent. And I would say that in this business, like in DeFi, being technical is great if you're doing something that's like a trading company. Like, I think you need that expertise somewhere. But if you're building a financial product, it can be a hindrance if you're technical with no financial product knowledge. Like we had the financial and the capital markets product knowledge, so we could actually come out and tailor the product for what the market would want. And so in that case, I don't think not being technical was as much of a hindrance as it might be if you're doing just a Web2 tech company.
That's so cool. Wow. I've spoken to a lot of founders, and yeah, almost always they're technical, or they build the MVP themselves or whatever. But for you guys to have the just be able to grind it out and just figure it out yourselves is super, super inspiring. All right, so Maple Finance, what year you guys launched? In 2020, I believe, right?
2020 we did the initial cap raise, and then it was May of 2021 that we first launched the product. So it was like a good 6 months solid of building.
Okay, awesome. And so take me back to that initial V1 launch. Take me back to those early days when you launched. Like, what was happening then?
I should say before then, for about a year, we just had one developer that we were paying out of our savings before we raised capital. So the very first version of Maple was like peer-to-peer loans. So I'd lend DAI to some guy who reached out on Facebook or something and was just willing to test the product. And so we're doing, these loans to like anonymous people on the internet and just hoping they would pay it back. But that taught us not to focus on retail because it's totally unscalable. And so then we refocused on institutions, raised the capital, and then built that product. And so then the early days, in the few months leading up to launch, we were trying to raise what you'd call now like a liquidity or a TVL round. As in you're just trying to get people to use the product and you're promising them tokens in order to put their money in the product, because you don't have a track record or a proven product yet. And so that was, February, March, April, trying to get that done, and just frantically, doing calls with funds and high net worth individuals on different parts of the world at all hours because we were in Australia. So you have to get up at 4 a.m. to hit the East Coast US, and then you have to be online in the evening to catch Asia. Sorry, not Asia, Europe, and and yeah, and so it was like a kind of nuts for 3 months just doing that. But then we got to launch, and that was so. Um, Once we got over that hurdle, we had to worry about launching the token, and we were super nervous about how that was going to go. So we launched that on Balancer, and then and then you're just trying to make sure that you don't get hacked. So it's like it's like a crazy period when you're going through that. But looking back on it now, it's looking back on now, I have totally different feelings about it.
That's so cool. I mean, what again, inspiring story. Okay, so you guys were hustling and grinding. You said, talking to folks all over the world for getting that initial TVL. What did you initially launch with? That initial TVL. What
That was so the first product. Maple's changed over the years, but um, back in those days, remember that everybody wanted to be a platform technology company. Nobody wanted to be vertically integrated, and so the business models were Airbnb, Uber, DoorDash. It was asset light intermediary, and we thought that was the best way to go. So the model we launched with was that other parties could be credit underwriters on the platform, and they would manage what we call lending pool, and they would choose the borrowers, negotiate the terms, manage the risk, and raise the capital. And so that was what we launched with. We launched with an initial pool. It had something like 20 million in borrowers, and it was raising capital super fast. Like I think when we opened it initially, the first 5 million came in a matter of minutes because people wanted to lock in these additional token rewards. And but we launched with that asset light model, and you'll see as we discuss how Maple's evolved, we moved away from that to a more vertically integrated model because we found that we were getting our margins competed away against other platforms. And if you don't commoditize somebody else in your value stream, you will get commoditized. And so that was a big lesson for us. And I think you can see that in other companies with like Apple, Tesla, SpaceX. Like I think Elon's companies are very good at vertically integrating. Whereas when you look at business models like Uber, they had to lose 40 billion cumulatively before they started getting to profitability. And so anyway, so I think the business model you start with may not be the one that you end up with.
That's so cool. Okay, so how so that's what the initial version was, kind of the peer to peer with everyone. You're essentially the open platform. People can use you, and people are underwriting and doing their own.
We wanted to remove the need for people to do their own underwriting. So it was more like, you, Andrew, could have managed a pool on Maple and been the underwriter, and then you show your track record and you say, I'm 10 years banking experience. I, have this incredible network, and I got all these smart people working for me who will do the underwriting. Because we saw with products like Dharma that the peer-to-peer matching was really tough to make work. Like you don't have 10 people who want to use your platform who also understand credit and are willing to do the underwriting themselves. And I remember reading white papers and academic papers when I was researching Maple on things like on deck and lending club, and the realized returns and how those platforms scaled, and they all ended up turning to institutional capital and pooling it and then loaning it out. So I was really certain that we wanted to avoid fully peer-to-peer, and so we went that peer-to-pool model, which I think was done very well by Aave and Compound initially, where you put your money into a pool, and then the pool might do larger loans rather than you having a peer-to-peer match.
So is that the current architecture that you guys have today?
Now it is, except we don't have third-party managers. So you, Andrew, could not come and manage a pool on Maple. It would be us, the Maple team, who are you could put money into a pool on Maple, but behind the scenes, it's all now managed by us. And that was because we found that, and we'll get to this, but in the aftermath of 2022, people didn't view us as just a tech platform. They viewed, we took the reputational hits where the other underwriters, had defaults and things. They didn't view it as like, oh, this underwriter on Maple had a default. They viewed it as Maple had a default. And so we were effectively providing the reputational cover. So we made two decisions. One was we focused on over collateralized lending because that market got totally wiped. And then the second was we just brought it all in-house. So it's vertically integrated. There's no third-party managers on the platform anymore.
Very cool. Okay, so yeah, take me back. You guys were operating 21, things were going well. 22, there was some hiccups. So, with the whole market, it went crazy. So tell me about what happened there when you decided to shift this model.
We had, across 2022, we had both ups and downs. So 2022, immediately prior to Luna, we peak at like 965 mil TVL. So we're closing in on $1 billion. We'd seen phenomenal growth. And by that stage, we'd been originating, over 250 mil in loans a month. So it was like crazy growth and momentum. Then there were two defaults on the platform over the course of 2022. One was Babel. So it was a large lender out of Asia that immediately before the default had just raised something like 50 or 75 mil from Dragonfly and a few others of their VCs. And they had a $6 billion loan book. So that one was not too material in the scheme of the pools. And then the other one was Orthogonal, who defaulted at the end of the year post FTX, and that was more of a case of fraud by the party. But so we learned lessons on managing withdrawals through that period. And so I think it's important when you have periods of volatility that you actually keep the pools as large as possible by kind of minimizing withdrawals. And so we changed the withdrawal mechanism in response to that. But the other element was we brought all of the underwriting in-house so that it's just us doing the underwriting. And then we focused more on over collateralized lending. So those loans had been under collateralized because we'd needed to we were a late entrant to the market, and so the over collateralized space was already very saturated. So those are the two major changes. But the other things that were actually wins over the course of 2022, initially there had been loans to Alameda on the platform, but our underwriters and us had taken the early decision to have them off-boarded and take repayment of all of those loans. So we had zero exposure to Alameda by the time that they defaulted. And then we'd also declined 3AC 3 times. So we've been through their financials 3 times, declined them. So even though there were challenges over 2022, we actually, I think, overall did a good job of surviving the mayhem, which caused many other peers in the space to close down. So then you get to 2023, and we, like others, had to look at what can we provide the market that people still want to buy from us. Effectively, what job are people still going to pay lending platforms to do? And so we made an early move into RWAs, so real world assets, and we did a effectively like tokenized T-bills type product. So you put money in a pool, the pool originates a loan, and the loan is collateralized by T-bills. We were just behind Ondo in getting that to market, and it felt like that difference was extremely important in the scheme of things now looking back. And so they did a good job of capitalizing on that. But before we knew it, there were 10 or 15 other competitors in the market. And currently, to my knowledge, nobody actually makes money on that product to date. So I still believe that all live T-bill products are being given away for free with none of the protocols making any revenue on them. So you can see we very quickly identified that that was not actually a market that we wanted to be in. And you can see, Ondo's TVL, about 650 mil. The boilerplate fees that they are supposed to be charging is 15 basis points. So you're on 650 mil, you're making less than $1 million in revenue. And most of them are not actually enforcing that 15 basis point charge. So they're giving the product away for free. So we didn't want, this is my philosophy, we wanted to be differentiated, and you can't be commoditized. And if you're one of 15 T-bill products, you're basically commoditized. So what we did though is we made that decision to bring the underwriting in-house and then to do over-collateralized lending ourselves, because Genesis, Celsius, BlockFi had all exited the market by that point. And so there was a wide open opportunity where nobody else was doing it. And if you look at the fees that are charged there, it's 150 to 200 basis points. So you're already making 10x the revenue in a differentiated product. So we went straight there, and it took us a few months to get up and running. But from September 2023, we've been running that product, and now we're back up at 640 mil of TVL over that period of time, and the revenue run rate is in the millions of dollars. Because we're able to charge 10x more than we were on the cash management product.
Wow. Okay. So there's a lot to dig into there. I want to go to you mentioned you spoke to Alameda and 3AC way back in the day, and your underwriting and the other folks on your platform, when it was the more open platform, they all denied it. So what did they, I mean, you don't have to talk specifics here. Maybe you can't, but what did they identify that was a little bit unusual, where you guys were like, this is not something we want to be involved with? Because Alameda and 3AC back then were like the kings.
Yeah, they were. And then they told us to shove it when we when we said, okay, we'll take our business elsewhere. They said, this is silly. Like, why are you asking for this? So 3AC had a corporate structure where it changed, and it was all of the wives of the principals who owned the corporate structures. That's immediately a red flag when somebody says, here's our corporate structure, and then a couple of weeks later they change it and it's all of their wives. That immediately, from a banking and credit background, that looks like you're trying to hide assets from creditors. And then the other thing was the financial spreadsheet that they sent had a bunch of errors in it that didn't toed out. And so we asked for corrections, and they said the other one had errors in it. So once you've done 2 rounds of errors on a spreadsheet of your financials, we just did not want to proceed there. And then with Alameda, we saw that balance sheet. Everyone who was lending to Alameda had seen that 30 June balance sheet. But what we did was we haircut the FTT exposure, and we went through line by line. So some of the issues they had by that stage, by 30 June, they had roughly something like, call it $14 billion of liabilities, and they had something like $7 billion of equity. But of that equity, it was like 5 billion was FTT tokens. So we handicapped that to 0 because we considered that if Alameda was in trouble, those are like, the FTT is not worth anything, which proved to be borne out in November, right? As soon as CZ said he was going to sell all the FTT tokens, you had this cascading effect. And the other thing was they had those 2 tokens, MAPS and Oxy, which I'd never heard of before, but they had them marked to 300 and 400 million respectively of equity on their balance sheet. And so we handicapped that. So by the time we handicapped the FTT and the MAPS and the Oxy and all these other liquid tokens, we got down to about $1 billion on, $10 to $14 billion of loans in equity. And so we just said, like, this is not a good credit anymore. Like we can't be in this. And so all of the loans were repaid, like 4 months or 5 months before they ended up collapsing. But I remember I was in meetings subsequent to that where I heard, very like experienced bankers saying, we believe in the SAM ecosystem. And by that stage, remember, he was coming in like JP Morgan and kind of propping up all of these other institutions that were on shaky balance sheet footing.
That's crazy. Wow. I mean, did you at any point were like, hey, maybe we were wrong? Like, or were you like, no, like we checked it out. The math is the math and it doesn't make sense?
Well, I mean, keep in mind that what we detected wasn't fraud. What we detected was that Alameda had a weaker balance sheet than was being represented, and so we declined to lend to them on a credit basis. We didn't look at that and say there must be fraud here or detect any, because you can't from those reported financials. So we didn't know that they were going to collapse like that. But what played out was the risk that we identified, which is that if FTT sells off, Alameda's balance sheet is going to be in this negative recursive feedback loop, which is the collateral drops, so they're going to get margin called, so they will have to sell other assets. And or get liquidated, and then if they're liquidated, FTT will drop further. So once FTT drops, they're in this cascading spiral, and that is exactly what played out.
What is your underwriting process today? Because you said you guys now all do it completely in-house. Has it evolved from when it was a more open platform, or is it similar?
Well, it's different in that because we place more emphasis on collateral now. So whereas before, when it was an open platform, you had these credit managers who would focus on the balance sheet strength and the earnings capacity of the counterparties. So they would look at, let's say like a Wintermute or a GSR or one of these other trading firms and say how much equity cushion do they have and how much income do they generate, and that would, and how many other loans do they have, and that was the basis of the underwriting. Now we'll still usually look at financials, for the reason that we want to know if this person gets margin called, are they going to be able to stump up more collateral? Like if somebody only owns 10 million bucks of Bitcoin and you take all of that $10 million, then as soon as they get margin called, they're not going to be able to post more Bitcoin to you. So that's really what you're testing for. But now we place more emphasis on the collateral. So we're looking at the volatility of the collateral. If somebody posts us XRP or Solana, that's going to move more than Bitcoin is during a period of volatility. So we have to handicap it and lend less against it generally, or make sure that they have more capital in reserve to post to us. So that's the primary way. It's more emphasis on what is the volatility of the collateral, how much liquidity is there. If we take the collateral, will we be able to sell it in a couple of hours, or will it take us days to sell it? And that determines how much you can lend and on what terms. But now, we've done loans against Solana, XRP. We've done them against Endel tokens of the Athena stablecoin, because that functions kind of like a zero coupon bond. But that's one of our core differences, and that's why people come to us today is two things. We can do that bespoke underwriting, and the second is that we're integrated with all the custodians. So you don't have to wrap your Bitcoin and put it in a smart contract. You can keep it at Anchorage, or you can keep it at BitGo, and we can accept it, in the custodian. So we have kind of this hybrid CeFi DeFi model now. But I would argue that the big lesson from the CeFi players of 2022 is you can't have a black box product. So that's why all of our loans are still on chain. So you can always see that they're performing, and you can go in the web app and you can see here's, borrower A, here's how much they borrowed, here's the collateral that they posted, and we try and show that transparently. Whereas, when you were giving money to the BlockFis or the Celsiuses, you didn't have reporting on how their loan book was doing. You didn't know how much equity they had to cushion losses, and you didn't know how much collateral they had against all of the loans. A lot of their loan book was collateralized, but a huge chunk of it was uncollateralized by the end.
Very cool. So with the on-chain transparency portion, you anonymize the accounts or the participants.
Yeah, you anonymize the accounts because otherwise you get
Right.
it's for most borrowers, they don't want people to know, I'm borrowing from Maple and I'm paying this rate.
Yeah.
And also, like if often you might have two peer companies who are competitors with each other, and one of them will come on and say, "Oh, well, this other guy is borrowing from you guys at 1% less than what I am. You need to drop my rates." And in 2022, you had a couple of companies who tried to insinuate that the other one was going to default on its obligations on Maple. So they go on and they post a screenshot of the Maple book and say, "Oh, here's this borrow," and they were a competitor of theirs, so it was malicious. And they would say, "Oh, we wonder whether they're going to be able to meet their repayments." So we keep it anonymous, and also who the counterparty is matters less when it's significantly over collateralized. I think if we were doing a pool where it was all under collateralized loans, which we're not really focused on at the moment. But if you're doing that, there would be more of a case to see who the borrowers were.
Totally. Okay, so on Maple today, who are the people? Who are the folks that are borrowing, and who are the folks that are providing that liquidity, but doing the actual lending?
So the folks who borrow are generally prime brokers. So it'll be prime brokers, um, some centralized exchanges, OTC desks, and then we actually have a few family offices now, particularly with tokens like XRP being accepted. And then the other one is like DeFi hedge funds. So they have an on-chain strategy. They might be long derivative of ETH, let's say, like Treehouse ETH, and so they post that to us, and then they borrow from us, and then they lever up that yield strategy. So, but it is all institutional. We're not really lending to retail. We've done some, ultra high net worth loans. Generally, that'd be for property investments or or just like cash flow management for their family offices. And then on the lending side, it's a mix. So as you pointed out at the start, we have the Maple permissioned product, and that's primarily it's a lot of high net worths, corporate treasuries as well, and then professional asset managers. So you might be managing $20 million on behalf of a foundation, and so you want to get them a healthy yield. So you might look at a product like Maple. And then we have the SyrupFi product, which is predominantly offshore retail. So that was done so that, somebody who's in Argentina, or they might be in the Middle East, or, Asia Pacific, and they're more at the kind of the retail size, and they don't want to go through the hassle of onboarding. They can go through that permissionless avenue, and they're still getting underneath the hood the same higher quality institutional yields that are over collateralized. They're not getting an inferior product. They're getting a product that's just as good, pays a yield in the mid-teens, but they don't have to go through the same kind of like onboarding hassle that onshore clients do.
So the lenders on Maple, I'm going to dig into Syrup soon, but the lenders on Maple, I've seen, on the platform, it's like yields of like 30% for USDC, and BTC, I think it's range of like 5 to 10%. How do you guys achieve such high APYs?
I wish we were getting 30% APYs. That I know the product that you're referring to. So the by and large, the vanilla lending is going to get you 9 to 11%. So vanilla lending against BTC, because that's just like the market's not it's not a brand new market anymore. So it's like it's relatively undersupplied, but it is still a mature product that most people understand. And so if you want to do the most conservative strategy we have, which is lending against BTC, you get about 9 to 11%. If you're willing to go higher yield and you're trusting our underwriting of a wider set of tokens, so XRP, Solana, Treehouse ETH, LBTC, then you can get 14%. I think it's paying net of our fees. That pays about 13.5 to 14% at the moment. So we're outperforming the rest of DeFi on that product by a good about 8%. So we get a very good realized spread for people who are willing to lend, and that's had no losses, no drawdowns. But the 30% product was a new one we launched after we actually launched that one in January, and the idea was, when you go into a bull market, people are less interested in a conservative 9 to 15%. They say, I think Bitcoin's going to double, so what do I care about your 9 to 15%? And if I do the basis trade, I'll make 20%. So we needed a product to kind of address that gap that we had in our product selection. And so we created a structured loan product, and we call that lend and long. So if you were to give us $1 million, Andrew, we give you a floor yield of 4%, so you're at least on par with T-bills. We take the money and put it in one of our lending pools, but we use the yield on it to buy a call spread. So we're effectively giving you levered upside to appreciation in Bitcoin. So if Bitcoin were to rip to 130K over the next quarter, that's where you make 30%. But absent that movement, we can't ordinarily promise you 30% because it's, that's an extraordinary return. But what we are doing is saying, okay, you think Bitcoin's going to do pretty well this year, but you might not want the volatility of actually owning Bitcoin outright, which is particularly true if you're a corporate treasury. your corporate treasury is not going to let you put Bitcoin on the balance sheet. But what you can say is, well, if Bitcoin rips, I could make 20, 25, 30%. And at worst, I'm on par with T-bills. So that's where that product becomes attractive.
That's so cool. Okay, so Maple has been a huge success. You guys have, I think I wrote down what $5.8 billion worth of loans issued over
Yeah, since inception. Yeah.
over 85 institutions that have used your platform, which is incredible. Um, how is the overall, the journey? Like, what would you, because it's been a bumpy ride. Has it been a smooth sailing? Like, how would you describe the journey of Maple specifically?
I'd say it's been bumpy. Uh, and there's a couple of sayings, like you listen to Jensen Huang and he talks about how it's painful and he doesn't know if he'd do it again. If he would do it, if he knew it all over again, I would do it because I don't really know how to do something else. And then the other Elon saying is it's like chewing glass and staring into the abyss. I'd say there have been times it's like the best part of it is the independence and the feeling of accomplishment when you hit a win, but you do zigzag between euphoria and abject despair. There end of 2022, we had to do a bunch of layoffs of great people on the team, and the TVL of the product was on on an express train to zero at that point. So that was the very bottom. But then you solve your problem and you work your way through it and you just keep grinding. And so I think it has been a great ride over the kind of the 5 years that we've been doing this. And I wouldn't do anything else. But I'd say one of the key things that stuck with me is one of my favorite podcasts, aside from yours, is Founders Podcast, where the guy David, yeah, he profiles founders and you see the kind of the trials and tribulations of it. But one of the things I've kind of picked up is that it's time in the market. The longer you do this, be a CEO or a founder, an entrepreneur, the more surface area you give yourself for luck to hit. And so if we hadn't ground through 2022, we wouldn't have come out in 2023 where all of our competitors were gone.
Totally. Yeah. I mean that podcast is absolutely incredible. Founders podcast by David Senra, amazing. Any founder or any investor, really anyone should check it out because it's super inspiring. But no, you're totally correct on like time in the market and survival. Like survival is the number one kind of objective there.
Particularly in a cyclical industry, because I remember reading. It seems unrelated, but I read this biography or the history of like Tyson. It was Tyson Foods or one of those meat companies, but it was the CEO decades ago would read all these business management books, but what they did was it was a cyclical industry, and every time it went through one of the ups, they wouldn't overspend or overinvest, and they kept cash in reserve so that every time they hit a downtrend, they just buy up more of their competitors. And that's how I view crypto is obviously very cyclical, and that's how I view it, is that each time we go through one of these cycles, we should come out a little bit stronger and try and capture some of those opportunities.
So how would you define the majority of the borrowers? Are these mostly kind of the market makers within crypto? Are they a lot of high net worths? Like what is the majority of the borrowers?
The majority of them are trading firms, but not necessarily the market makers. When we started, the market makers were our major clients because they wanted to borrow uncollateralized or unsecured. As our business has become predominantly over collateralized, it doesn't work for them anymore, because the way that you should think about over collateralized borrow is that that person has to have some kind of cost or friction to shifting between assets. If they have Bitcoin but they want dollars, that person to want to borrow from us, they have to not want to sell their Bitcoin. Whereas market makers are trading thousands, hundreds of thousands of times a day. There's effectively zero cost for them to swap from Bitcoin to dollars. And so we can never really be competitive with them unless they have something that they are restricted from selling. So it's it's your large OTC desk. Sometimes it's a centralized exchange desk. It's a lot of hedge funds. And now we've started to make inroads with high net worths, which I've wanted to do for a long time because they're sticky relationships, they're good, durable business, and they move in networks. So when you help one high net worth get a loan, then he goes and tells all of his friends, his or her friends, and then suddenly you've got a whole bunch more customers. So I think that's a great business that we want to do more of.
Very cool. And also, I could be incorrect, but I think you can use your staked assets as collateral.
Yes, we'll take all staked assets. Yes, exactly. That's one of the selling points of our product versus something that's purely DeFi, is that if it's purely DeFi, you have to take your assets out of BitGo or Anchorage or Copper and put it in a smart contract. Whereas we'll let you keep the assets with those custodians, and indeed we've done a couple of large loans that way. But I think that hybrid, people will increasingly want to keep their assets at custodians. So I think you have to have that option.
That's super cool. Okay, so you have Maple, which is the kind of institutional grade permissioned DeFi platform. Syrup. What was the thought? You mentioned it briefly, but what was the thought process around launching Syrup?
Syrup was a distribution play initially. So the idea was, okay, uh, early 2024, we have the institutional business was growing, so we're starting to pick up more money from institutions. But we saw the launches of these products like Athena, doing an integration with Pendle, and that was an immensely successful partnership. I think they have over $1 billion of TVL in there, but we're missing that distribution play. So it's like you have, it's like you have only online but no, or rather the inverse. It's like you have brick and mortar distribution but you have nothing online, and so we needed to get that distribution leg up and running. So that was the idea for Syrup. So we had to come up with this legal structure offshore to make it happen, so that we could have offshore Cayman entities that could take in the funds from DeFi and then lend them out. But we made the decision to go to treat it as a separate product under Maple, because we wanted that separation from Maple permissioned institutional versus a more retail and offshore and DeFi facing product. So the assets we got out of it were, we could then very easily integrate with partners like Pendle, which has been a great partnership and integration for us, because we get capital in from their users, they get extra points from us. Um, so we wanted the offshore integrations. We wanted to be able to tap retail. I mean, it makes total sense when our yields are outperforming the rest of DeFi like they are. We think we should be picking up more volume, and we are starting to see that now. But that was the idea, was we needed an extra leg of distribution. We weren't active in the regular DeFi market, and we weren't picking up any retail capital.
Could you imagine?
We launched it in 3 months. So we went from discussion to first dollars in the pool between March and early June. So it was like, and that included coming up with the brand of Syrup, all the designs around it, and the POC webpage.
That's really cool. Wow. All right. So, can you imagine a Syrup having more TVL in the future than Maple, or just like the retail dollars are not going to not going to be comparable to institutional?
Potentially. I still think I think they can both be great products. So I think Syrup is going to be more leverage. I mean, a lot of the money coming into Syrup is still whale money at this stage. Like you get, a $500,000 deposit from a DeFi whale. But Syrup is very important for growing protocol partnerships. Like I mentioned, Pendle. We also really like the Spark, Spark MakerDAO ecosystem as well. And so we would love to do more there, but they're going to require something like Syrup rather than the regular Maple product. And then if you look at what's happened now post-election, there's much more institutional appetite for on-chain activity. And so, in July last year, Cantor Fitzgerald announced that they were going to get into the business of lending against Bitcoin. So we look at that traditional financial institution um, market as an opportunity set for regular Maple. Those people don't want to go into a smart contract. They don't want to look at, branding like Syrup. They want something that's more institutional, something that's buttoned up, something that they have to go through more onboarding to use, and that's more segregated and conservative. So I think the big opportunity on that side of the business, that Maple institutional, let's call it, is starting to partner with those institutions. Because if you look at it, they're very late to the game in getting into Bitcoin-backed lending. In a lot of cases, they don't have the technology set up. They haven't been through the stress tests. And so how we're trying to position ourselves is as an early partner to them. Give them distribution, allow them to get from 0 to, 10 or 20 million in loans done as quickly as possible so they can rack up some wins on the board. And whereas syrup is a more segregated product.
Very cool. Okay, so take me through the user flow of that DeFi whale who's depositing 500K into Syrup. Are they putting in ETH? Are they putting in USDC? And also, then where is that being lent out to? And is it locked for
USDC.
6 months? Okay, USDC. Okay,
USDC. And this is the other thing that we've got to do to grow Syrup from here is so they were depositing USDC. Most people don't want to borrow ETH. There's not a lot of demand for it because it's very easy to source from other parts of DeFi. So no yield on ETH, no real borrow demand for it. They want dollars. And so currency of the realm is USDC and USDT. We find more appetite to borrow USDC rather than USDT, although USDT demand is more Asia based. But anyway, coming back to your question, the whale is going to SyrupFi. They connect their wallet and then they can just deposit USDC straight away. So they just have to go through the approve the transaction, and then deposit it. They get back an LP token, so they can instantly see that their wallet is starting to earn them yield. And then they can withdraw anytime they want. So we don't restrict or impose a lockup on it. But of course, it's subject to liquidity being in the pool. Most of the time, though, that's been less than a day, unless you're a huge chunk of the pool, in order to get those funds back. So it's a different flow. It's intended to just be simple, like really simple to use, as few clicks as possible to get into a pool and start earning yield.
very cool. Okay, so
What we have to do though for Syrup is the big focus is how do we increase secondary liquidity so that they can instantly get out of the pool all the time instead of just when there's cash in there. So I think that's a big challenge for us to unlock. And it's kind of how the way that we approach things. Instead of trying to do these big incremental lifts, we just kind of look at like what is the next smaller increment that we can unlock that will make the product better, faster, cheaper for people.
MPL token, Maple token. I believe you guys went through a process where people are converting their Maple into Syrup. Can you talk about that process?
Yeah. So, when we had the initial MPL token, we did a fixed cap on it. So it meant that you couldn't mint anymore. Now, in the last DeFi cycle, a lot of people try to do this because the mental model was Bitcoin, and so Bitcoin has a fixed supply. So that was the meta that everyone was going with. However, as a startup and as an emerging protocol, we go through highs and lows, and then we couldn't predict all of our funding needs from back in 2020 when we first created the token. And so going through a bear market, we had to do a fundraise for the protocol, sell some more tokens. And so we then needed to mint new tokens to meet those obligations, as well as the other, ongoing costs of funding the development of Maple. And it was either pack up and walk away and everybody goes to zero, or mint the additional tokens and cop the dilution. But as I said, the number one priority is like surviving and continuing through to the next cycle. So we did a vote to create the Syrup token, and then we set a date of November last year for the migration. And so we had to work with the exchanges, work with everyone who was holding MPL to prime them for the migration and allow them to go through the migration. Now, we didn't get supported on every centralized exchange, which I think annoyed some people. However, we got almost all of them, and to date, about 70% of MPL has been migrated. And there's been a very clear timeline of holders of MPL have until 30th of April to complete the migration. So we're trying to give people plenty of time, make it super easy to use it, and to clearly explain why we had to do it. Nobody likes taking dilution, but if it's the difference between stepping off a cliff or being able to continue, I think the choice was pretty obvious. And what we've done now is we've introduced staking for Syrup. So if you stake Syrup, you can vote, and you'll get about a 5% rewards APR, which comes from a mix of the token inflation as well as buybacks. So what we've done now is we've implemented a buyback. We started using protocol revenue to buy back the syrup tokens and distribute those as rewards to stakers. I think if you look at what happened last year, there was a massive overemphasis on infrastructure, and you've got a ton of these L1, L2 ghost chains that nobody's using that have multi-billion-dollar FDVs, no users, no revenue. I think the fee switch and buybacks and other revenue return mechanisms will really set apart protocols this year. And so we're trying to get an early lead on that. And so people who have syrup who stake it can benefit from the buybacks.
Very cool. Okay, so yeah, that comes to mind the idea that potentially with this new administration we could get some regulatory clarity around cash revenue,
Yeah.
flowing back to token holders.
Yeah.
And buybacks is kind of some way around that mechanism. What are you thinking in that realm? Are you thinking like, oh, we could literally have people that token holders get direct USDC, or what are you thinking?
In a mature state, yeah. Like that's what I would like to see. Um, you know, America obviously has different treatment of dividend taxation, so that's why most publicly listed stocks will tend to favor buybacks, share buybacks. But I think that's the cleanest way of just returning protocol revenues to holders. I think even with the more pro-innovation administration that's trying to set out guidelines on crypto, you're probably a ways away from just being able to distribute USDC to holders. That being said, I mean, Coinbase pays out USDC rewards to people who are holding USDC there. So maybe there is a legal construct where we could do USDC rewards to holders. That would be like ideal in a mature state. But in the interim, it's going to be that you stake your syrup. So you have ST syrup, and then you receive more syrup, which comes from, buying back syrup on market and then distributing it to the stakers. So let's say that's like an interim step on the way to to sort of fully returning capital to token holders. But that's one of the advantages of doing this in token form, right? Like that stuff would be incredibly cumbersome and difficult without tokens being held in wallets and being able to stream rewards to it. But Maple makes revenue run rate, we make about 5-ish million annualized, and then expenses are between 6 to 7. So the protocol treasury is very healthy, and over the next few months we want to try and get to profitability, which comes for us from growing the loan book. So we make about 150 to 200 basis points on the size of the loan book. It's about 240 mil at the moment, and total assets on the platform about 640. But we have effectively a leveraged business in that I don't need to hire twice as many credit analysts if our loan book doubles, and I don't need to hire twice as many engineers. So you start to get the software economics of scale, whereas your incremental revenue just drops to the bottom line.
That's very cool. Wow. So do you think that a lot of the protocols will prefer, once we have regulatory clarity, will prefer direct cash back to token holders? Because I feel like, I don't know, I feel the design space around tokens is unlimited, right? You can literally you can design and do whatever. So I don't know. I feel like maybe they're going to prefer the buyback structure, or maybe they'll prefer some different structure we're not talking about. What is your opinion?
It's a good question. I think the buyback structure will remain currently preferred for the time being, because if you look at American token holders, they don't want to pay double taxation. I'm still not sure how the initial layer of taxation would work, because obviously in equities you have the company pays corporate tax, and then they pay a dividend, and then people pay income tax on their dividends, and so equities opt to do buybacks. I think for the time being, buybacks will be preferred, because it's simpler than distributing USDC to a bunch of people mechanically. And for most of the teams and VCs that I talk to, that's generally the preference. So I think for time being, yes, you would need to see more legal clarity in order to be able to distribute dividends, because otherwise it then classes you in the category of securities.
And we talked about moat briefly, but how do you think about building moat? 'Cause on the Maple side, that's understandable. It's kind of this vertically integrated product, but on the syrup side, it's like kind of by default doesn't really have necessarily a moat. But how do you think about building a moat within your businesses or protocols?
Well, I think in the business that we're in, scale gives you a lot of whether you call it moat. I recently heard referred to in the context of Nvidia and Jensen as kind of network effects, but um, whether you call it one or the other, I think scale is extremely important in lending because it gives you a cost of capital advantage, and it gives you the ability to be not the lender of last resort, but you can basically fill any ticket size after a certain point. I read great book was the Predator's Ball on the original.
I'm reading that right now. So good.
Oh, it's fantastic. It's so good. But what is often lost is that even though Michael Milken um, obviously had a fall after that, all of the successful firms that you know today in the private credit space, so Apollo, Ares, they all came out of the alumni of Drexel Burnham. Um, and so, but one of the really interesting things early on was as he was making the market in the high yield bonds, he was issuing them, but he was also able to buy them and make the market for it. When you have scale, you can make the market in lending, and somebody can come to us. We have we have a pipeline of like 100 mil in loans. And so if we had scale, we can instantly, approve and fill those. So anyway, that's the one thing. But on the syrup side, I think density of integration. So having Pendle, having Maker, um, having secondary liquidity. I think this is one of the things that Athena did extremely well was they built this massive amount of secondary liquidity for USDE. And so if we can have that for the Syrup LP token, then you can instantly get in and out. And that's similar to making the market. Then people have our loan exposure and then they can sell it back to a pool. And so that scale, when people can get in and out instantly, why wouldn't you go in that over an Aave? Because you can get 8.8% more than you can on Aave. So I think liquidity and balance sheet scale are the two most important things. And then I just think ease of use. I see a lot of protocols that are not simple, not intuitive, and so I think that's just something you kind of have to whittle away at over time.
So building off this kind of theme we're talking about, what do you expect the future of? Did you expect all credit debt markets to go on chain? Like, is that actually what's
Yes.
going to happen? Or
Yeah,
oh, actually,
100%.
okay.
And actually, two other things. So on the mode, if I like Aave is not integrated with custodians, right? And so you can't have native Bitcoin or native Solana and go and use the Aave protocol to borrow, whereas you can with Maple. You want to post your Bitcoin while it's in Anchorage and borrow 10 million bucks. You can do that. Um, so I think that width of assets, the integration with all of the custodians, um, that also starts to form part of our moat. So you can get the most credit on the most amount of assets with the least counterparty risk. Like those are the types of things that we would push on. Um, and then over time, we won a deal recently because we onboarded the customer in 3 days and we were able to settle with them in 4 days. Whereas they wouldn't have even onboarded with the other parties that were bidding to win that deal. And that was, more than 3x over collateralized, like very desirable borrower. But we won the business because we just hustled more. We wanted it more. So I think that like that hunger is also super important. Um, but to come back to your other question, yes, I do think all capital markets move on chain over time in the same way that almost all commerce eventually became e-commerce.
So tell me as to why. I mean, obviously, I have my own thoughts, but
Yeah.
like, why are you so certain on that?
Well, I worked at a bank, and so I think from the outside in, you kind you see the Instagram representation of how a bank would like you to see it as. But on the inside, whenever I wanted data on, how are the home loans performing, or how many mortgages do we have in these districts, that's like a 4-day process to request, and then you have to go through because a lot of the data is wrong because it's just tagged incorrectly. So um, that data becomes much easier to manage on a blockchain. But effectively, like you're starting to see the kind of the chips falling away from these large banks. The systems don't work well. They don't capture data well. They are running at really high costs. And every time they invest in new technology, they're not deprecating the old technology. So at National Australia Bank, they had this product called this project called NextGen, which they'd been working on for 6 years by the time I entered, and it still wasn't done, and it was over budget. And then by the time they finished it, they couldn't decommission the old system, which ran on COBOL. And so you'll hear a lot of talk on COBOL about COBOL if you're following the Twitter discussions of Social Security. It's a very old database language, but that's what all banks run on today. And so um, I just don't think they have the escape velocity to get off that onto more modern systems. And so uh, that's why I'm so bullish on all of finance being run on a blockchain where you have a distributed ledger and you can track every event that happens. So you can recreate the entire history of all financial transactions conducted by a bank if that's done on the blockchain. So effectively, I think it doesn't happen because people just go, this is better technology. It happens because we can serve a client faster than what a bank can. We'll onboard them faster. We can serve them in Japan or Canada or the UK without any marginal cost versus what a bank can do. And so anyway, that's one trend driving this. The other is regulatory capital. Basel is super conservative, and it's probably not the right risk framework for most banks. And every year it gets more conservative and means banks do less business with less customers. So 30 years ago, banks would have had no problem doing loans to small businesses. Now, if you're a small business, for the most part, you're going to have to go to a non-bank lender, what is called a shadow bank. And that's because the regulators in Switzerland decided that the lowest risk form of lending banks can do is just to give people home loans. And so that's most of what they do. And so banks are shrinking, and that business shrinking the customer set they serve. And that business is going currently to Ares and Apollo. And I view them as our ultimate competitors. Like that's kind of who I want to go after in the end. And they have no real tech underpinning what they do. Like they're when they send a loan out, that's actually JP Morgan sending a loan to somebody, and they are just the account holder on there. So I think our vertical integration, the fact that we effectively control the bank accounts, the systems that read the bank accounts, and the end customer relationship will give us a speed and a cost advantage that mean that over time we'll be able to pip them on, middle market lending deals that aren't readily, you wouldn't readily relate those to crypto or digital assets right now. But eventually everybody's going to want a USDC or USDT loan, and they'll be happy to take it in a digital wallet.
So it wins just by having literally a superior product. It's just like, this is just by far better on every aspect almost.
Yeah, try sending a wire and copping the $25 fee on, some amount in the few hundreds versus sending USDC directly to somebody that settles on a weekend.
Totally. So, okay. So what I guess in that future, like what do banks do? Like, do banks still exist in the future you're talking about?
I don't know. Like I think banks still play an important role for the functioning of society, right? If you look at the core of what a bank does, it is maturity intermediation. You have cash and you want to be able to get the cash back at any time. And then other people want home loans for 30 years and the bank can do that. That is like a really important function. It's not clear to me that there's a replacement for that function in society. Like you don't, if you have cash, you don't want to put the cash with Apollo and tie it up for 30 years so that they can, write a 30-year mortgage. And there's not another pillar of the financial system that fulfills that function other than banks. So I do think they're important. I just think they become a narrower set of business. Like in future, you're not going to go to the bank for small business loans, large corporate loans. I think over time they will coalesce, more akin to what like the original savings and loans did. They'll just do retail mortgage loans, and that will be an important role in you, and you'll keep your checking accounts there. But for investment and yield products, and for what institutional allocators want, I think that will go to what is currently called the shadow banking sector today. And that will include, fixed income products like Maple, where you want to get 10% or 15%. And large corporate borrowers will eventually come to us instead of going to banks.
What role, if any, will like your credit rating, your on-chain credit rating play within this future blockchain, financial ecosystem?
I've always liked the idea of on-chain credit ratings, and I kid you not, I wrote an article back in 2019 or 20 early 2020, which was basically about hashing your eye or some kind of biometric data into a unique identifier for you, and that obviously WorldCoin then, they didn't take my idea, but they had
Oh, you're yeah.
the same idea and execute on it much better. Um, but we tried doing that, and we tried having credit scores for on-chain borrowers. But the problem is that most activity currently still takes place in centralized exchanges. So if you go and give a loan to a Wintermute or a GSR, the money is going to go to a centralized exchange, and then you lose track of it. And so you're not going to accurately represent the true credit rating of that party. So I think it will come over time, but you'd need to see more activity shift, or the center of gravity shift away from the centralized exchanges into, on-chain activity. Maybe if Hyperliquid is more, is super successful and takes all the perps volume in the market, then we'll have a really clear answer there.
Very cool. All right. So how do you think about hiring? Because you have these traditional skill sets that you guys are targeting and operating within, but then also a lot of on-chain crypto weirdness. So when you are building out your team, are you looking for crypto natives? Are you looking for people with TradFi experience? Some mixture.
I think the answer is a mixture, and it's the right fit for the right role. So we just hired a community manager last week. So the right fit there was much more crypto native. Not looking for anyone with TradFi experience there. You want somebody who's deep in the weeds of crypto. Um, for capital, like our capital markets team was probably where you have the toughest balancing of that. And largely what we've done is kind of gone for people who have um, some TradFi experience. Like they probably worked at least one job in TradFi, and then most recently, before coming to us, they were working in crypto. With one exception, we have one guy who's done very well, who his job immediately before joining us was in TradFi, and he was just crypto interested. Um, what I found is that the people who were too long in TradFi were too institutionalized and couldn't, it was just like crypto moved kind of too fast for them, or the conventions, they were too used to working at TradFi speed, which is much lower, much slower than what crypto speed is. So we needed to find people who are still relatively young, um, but I would say anyway that's been the most important aspect. What I would say I've gotten much better at is I read a book called, I think it was called Who, and it's like the title of the book is Who, and it's a really good book on hiring processes. So just being very like crystal clear. One of my favorite questions now to ask is like, what would your prior boss, like if I spoke to your boss from this job, what would they rate your performance out of 10? And it's just super, super transparent. It's really hard to evade and say, oh, well, I do this and that. Like they have to give a number. And then you do the reference checks. So you verify, like, is this actually what the person would get out of 10? So reference checks and just being crystal clear on those questions. And hiring, I generally try and hire a little bit more for kind of, you know, call it like culture and raw ability rather than necessarily the exact experience doing that exact thing previously. I think if it's a trope, but if you hire really smart people, they'll work out how to do it.
How would the folks that you work with describe the way that you manage and operate the business?
Well, fortunately or unfortunately, I don't have to guess because I did just do a 360, but I think they would highlight that it's kind of, hard driving. Like I think, I try and set stretch goals. I'm working all the time and I try and push for things to be done as quickly as possible because I think speed is like one of the few things we can control that gives us an advantage over our competitors. Um, so, fast paced, kind of demanding. I think what I try and do that, maybe I could get better at is just consistently giving people like reasons for things and connecting it to the higher purpose of what we want to achieve. And I think that's really tough in a remote world. I'm here in Miami. A lot of my team's in New York. We have people spread out in London, Dubai, Barcelona. And so, you do miss the kind of the water cooler chit chat and modeling behaviors in person. So the other thing we try and do is get together at least once a quarter for, more of an offsite where we talk what are the big projects you want to get done over the next quarter, do some team bonding, that type of thing.
Very cool. All right, Sid, what is the grand 10-year vision? Like, where is Maple, where is syrup going to be within 10 years from now?
It was a tough one. I hover on this back and forth between, just like showing up and steering the ship and kind of steering more towards short-term goals rather than trying to plan, plan in specificity some grand, grand destination. But I do think my overall goal kind of remains the same, which is I want us to be the biggest institutional lender. I want us to be the number one institutional lender on chain. And so that 10-year goal is still going after, Ares and Apollo and being that biggest institutional lender. So everything that's in that direction is kind of where I try and steer the ship, and then like what I would consider to be our North Star. So let's say by 2030, I want us to be doing, tens of billions of originations every year.
I love it. All right, Sid, it is time for the closing questions. All right.
Shoot.
February 2026, next year, what is the price of Bitcoin?
I'll say 185K.
Ooh, like it. All right. All right. You are not allowed to work on Maple/Syrup. You're not allowed to. What else would you be working on?
If I couldn't work on Maple/Syrup, if I couldn't do something in crypto, I have been really interested in desalination recently. I've heard the podcast of this guy, Samo Buria, who does like the Live Players podcast. But coming from Australia, I wrote a high school thesis on the water market, and I'm really interested that with desalination, you could like regreen, a country like Australia, which is a desert, and maybe Australia could support a population of 300 million people and be a superpower if you could do that. So, if not Maple and not crypto, it would be desalination.
That's super cool. I have an odd fascination with desalination too. I used to live in the Middle East, so I that was like where everyone got their water. The issue, you probably need fusion or where, because even with
you need massive amounts of energy to run and to operate it. So I think I'm super interested in nuclear energy as well. But there's already a number of people doing really good stuff in that area. So though you need fusion, I don't know that I'm the fusion or a lot more nuclear fission even. I don't know that I'm the guy to do that, but I've been fascinated with desalination. Imagine that you could fully irrigate the Nevada desert.
Amazing. Yeah. Now, Australia, you're right. If you flooded the interior of Australia with fresh water,
landmass close to the size of the US.
Yeah.
Like rich in minerals. Like if you could do that and you could grow the population to 300 million, like Australia would be a serious superpower.
Amazing. All right. What is the best advice you've ever received?
Best advice I've ever received. Well, I think just keeping on grinding, like just keep going. And is probably like, let's say that's the number one, but the other one I would pair that with is just simplifying things as much as possible for execution. We experienced this with V1 of Maple. When we're making the first proof of concept, we tried to throw everything at it and we wanted to add all these features. And the more I found is just execute in increments, get the first thing right. And you can always add other stuff later. So I'd say that's probably the most important piece of advice I could give to other people looking at starting something, is just concentrate on the simplest thing you can execute. And you can see that with Elon as well. He's obviously much better at it than the rest of us, but what he does well is he finds like that one most important thing and just throws all of his leverage on that thing.
A great example is like, oh, Pennsylvania is important. Okay, let's go to Pennsylvania.
I was about to say Pennsylvania in the elections.
Yeah.
And then with Tesla, it was, there's that point in the Isaacson book where he just has to get to 5,000 vehicles a week. Like he just finds that one thing.
Yeah, totally. All right. What trend is totally overhyped and what trend do you believe is underhyped?
Trend that's overhyped. Well, I'm in the crypto space. I think meme coins was definitely overhyped. I think AI is probably slightly at risk of being overhyped, but overhyped in the short term, but probably underhyped in the long term. Like I do think that in time, there was this book called like The Age of M. I think it was that economist Robert Hanson, but everyone effectively runs simulations of themselves that can kind of do things at the speed of light. And I think of everybody having dozens of agents in future that'll all be running money for you and, doing business operations. So I think AI plus crypto is going to be massive longer term. And so I think short term overhyped, long term underhyped. And the other underhyped thing is I do genuinely believe all finances is going to move on chain in time.
Love it. You said meme coins is like a past tense, or like meme coins is
It's still happening, yeah.
yeah. So do you imagine it'll taper off, or do you think it'll continue to
Yes.
be?
I
Okay.
my view on meme coins is that it's inversely performant to DeFi, because
Mm,
my take was that meme coins were the equal and opposite reaction to the regulatory clampdown on DeFi. So if you wanted to launch a token with utility and have a functioning DeFi protocol, the SEC would sue you. And so the opposite to that was just anonymously launch a coin that has no obvious value or utility and pump it. And so I think as we're now entering a more favorable regulatory environment for innovators, um, there's less effectively the boot is off the throat of DeFi. And so I think DeFi will do better and that will hopefully suck the oxygen out of the room for meme coins.
very cool. All right, last one. What does success look like for you?
Success, I think, independent control of how you spend your time, but most of all, I think it's building something that leaves an impact. So I look at, for Maple, success for me is I want to build a really important company that leaves an impact on a lot of people and that is recognized as the best in its space. Like I think a lot of people try and connote things to sort of higher order impacts now, but I think there is something really satisfying about just being the best in your space. And so for me, success is building something that, where we are the unquestioned leader in the space of institutional lending.
Amazing. Sid, thank you so much for coming on. This was incredible. Where can people find more about yourself and learn more about Maple and Syrup?
Well, first of all, thank you for having me. So people can learn more about Maple. So we are at Maple Finance on X, and then on X I am at Syrup Sid, one word. And then our website is maple.finance. So feel free to head there and sign up. Otherwise reach out to me or to Maple on X.
Awesome. Thank you, Sid.
Thanks for having me.